So if you're a homeowner with a good amount of equity built up, but you don't want to take on another loan or monthly payment, Point offers a pretty interesting alternative. It's called a home equity investment, and it's designed to let you access your equity today without adding debt, interest, or a monthly repayment schedule. Instead of borrowing money, Point gives you a lump sum of cash up front. In return, you agree to share a portion of your home's future appreciation. That means when you eventually sell, refinance, or buy back the investment, Point gets repaid based on how much your home has gone up in value, not just a flat cut of what it's worth today. And the key thing here is that you're not giving up ownership. You still stay on the title and you're still responsible for the home just like you would be normally. The only change is that Point records a lien, basically a claim, similar to what a lender would do. They don't actually take control or any share of your home itself. So in this video, I'll walk you through how Point's home equity works, the protections they build in, and whether it's something that might be a better fit than a HELOC or traditional home equity loan, depending on your situation. Now, one key safeguard in how Point structures repayment is that you're only paying based on what your home gains in value, above a baseline called the appreciation starting value. So if your home appraises at $500K, but your agreement starts at $470, only appreciation above that $470 mark is counted toward the amount you'll owe. This setup helps protect the equity you've already built and ensures you're only sharing future growth, not what you already own. There's also a protection cap that limits the maximum you could owe, even if your home skyrockets in value. It uses an annualized percentage that compounds monthly, and in most cases, it'll keep your repayment within a predictable range, especially in the first few years, where that starting value is set a bit below the home's appraised amount. On the flip side, if the housing market goes the other way and your home loses value, Point shares in that loss. So if you sell for less than the starting value, you might repay less than what you originally received. It's a built-in downside buffer that you just don't get with loans, where you owe the full balance no matter what happens. And when it comes to timing, you can repay Point at any time within the 30-year term. There's no prepayment penalty, but repayment has to be a single lump sum. That gives you flexibility, though it's worth planning for since partial paydowns aren't an option. So if you're interested in moving forward with Point, the application process is set up to be quick. It starts with a 1-minute pre-qualification online, which includes a soft credit pull, so there's no impact on your score. From there, Point orders an independent appraisal to determine your home's value. They use that appraisal to calculate your starting value and how much equity you're able to access. Once that number is finalized, you'll receive a formal offer, and most deals close in about 3 weeks. Now, there are a few fees to know about. Point charges a 3.9% processing fee, which is deducted from the investment amount at closing. There's a $2,000 minimum on that fee, so smaller deals will feel it more. You'll also see the typical third-party closing costs: appraisal, title, escrow. Those usually run between $1,000 and $1,600-ish, depending on location. You might also run into small charges like a credit report fee or flood certification, but nothing unusual. As far as eligibility, Point accepts credit scores as low as 500. And there's no income requirement, which can be especially helpful if you're self-employed or retired. Your home needs to be in one of the states that Point serves, and it has to meet a minimum value of $155,000. So most single-family homes qualify, but properties like co-ops and manufactured homes aren't eligible. And hey, if you're thinking about giving Point a try, there's a link down in the description and in the comments section. We usually have deals there that you won't find if you just go straight to their website, so feel free to check that out if you're curious. So one of the biggest advantages to using Point is just how much flexibility you get compared to a traditional loan. There's no pressure to repay early, and you have up to 30 years to settle the investment. That can be through selling your home, refinancing, or just using savings if you decide to buy it back directly. And since there's no prepayment penalty, you're free to exit anytime without getting hit with extra fees. Another benefit is the Point doesn't show up as debt, so it won't affect your credit report the way a loan or a HELOC would. That's especially useful if you're planning to apply for other financing and want to keep your debt-to-income ratio low. There's also an option called Repoint that lets you replace an older home's equity investment with a new one. So if your home goes up in value and you want to access more cash later, this gives you a way to do it without starting over. It does require a new round of underwriting, but it can be helpful if your financial needs change over time. And if you're thinking long-term, Point investments can be assumed by your heirs. That means the agreement doesn't have to be settled immediately if you pass away, and your family gets some flexibility in how and when they repay it. For a lot of homeowners, that kind of estate planning benefit is a major plus. So if you're weighing Point against more standard options like a home equity loan or HELOC, the biggest difference really comes down to structure. Loans and HELOCs give you fixed terms, regular monthly payments, and interest that can add up quickly, especially if rates climb. And to qualify, you'll usually need strong credit with steady income and a relatively low debt-to-income ratio. With Point, the trade-off is instead of paying interest or committing to monthly payments, you're sharing a portion of your home's future appreciation. That could cost more or less in the end, depending on how much your home grows in value, but in the meantime, you're not adding any debt to your credit report or taking on another monthly bill. And that can be a big relief if cash flow is tight or uncertain. So Point tends to work best for homeowners who have equity, need cash now, but either don't qualify for a loan or don't want to take one out. It's especially helpful for anyone who's self-employed, recently retired, or just going through a transition where monthly payments aren't ideal. So hopefully you found this review helpful, and if you did, please give it a thumbs up, as I always appreciate that. And if Point sounds like it might be a good fit for your situation, check out that link in the description. Like I mentioned earlier, we usually have special offers there that you won't find just by visiting their site. And if you have any questions, feel free to drop them below. I love getting to answer as many of those as I can. Otherwise, thanks so much for watching, and I'll look forward to seeing you in the next video.